accounting conventions. Conventions are the customs or traditions guiding the preparation of accounting statements. They are adapted to make financial statements clear and meaningful. They represent usage or methods generally accepted and customarily used. This exists in cases where there are different alternatives which are equally logical, and some of these generally accepted, having consideration of cost, time, habit, or convenience. Let's talk on the conventions of the account. We have many. Let's take number one. Number one is convention of disclosure. This convention of disclosure means that accounts must be honestly prepared and they must disclose all material information. What I mean by material information is every due fact on the financial information should be disclosed when preparing it. The accounting report should disclose full and fair information to the proprietors, the creditors, investors, and others. The term disclosure only implies that there may be a sufficient disclosure of information which is of material interest to proprietors and potential creditors and investors. Number two, we have convention of materiality. The accountant should attach importance to material details and ignore insignificant details. If this is not done, accounts will not be overburdened with minute details, therefore keeping the convention of materiality in view. Unimportant items are either left out or merged with other similar items, whether the information is material or not. This depends usually upon the circumstance and case and common sense. Now, the rule to be kept in mind is that if omission of information impairs the decision or conduct of its users, it should be regarded as material. However, an item may be material for one purpose but immaterial for another, material for one concern but immaterial for another concern, or material for a year but immaterial for the next year. Number three, we have convention of consistency. Under this convention of consistency, the comparison of one accounting period with the other is possible only when the convention of consistency is followed. This ordinarily means that accounting from one accounting period to another should be on the same basis. Now, if stock is valued at cost or material or market price rather, whichever is less, this principle should be followed every year. Any change from one method to another will lead to inconsistency. However, consistency does not mean non-flexibility. It should permit introduction of improved techniques or accounting. Number four, convention. We have convention of conservatism. By this convention, all prospective losses are taken into consideration, but not all prospective profits. In other words, or in simple terms, we should anticipate no profit but provide for all possible losses. This convention is being criticized on the ground that it does not only go against convention of full disclosure, but also against the concept of matching costs and revenues. This concept also encourages creation of secret reserves by making excess provision for depreciation, bad and up to debt, etc. The income statement shows a lower net income and the balance sheet overstates the liability and understates the assets. The differences between accounting concepts and conventions. Accounting concepts refers to the fundamental principles and assumptions that underlie the preparation of financial statements. Meanwhile, accounting conventions refers to the established practices and procedures that are commonly accepted and followed in accounting.